Hi, once again, David Moore of Equity Advantage here with Coni Rathbone of Dunn, Carney, and we're talking everything Opportunity Zone today. So Coni, I guess one of the questions we get is they call us wanting to know how we 1031 them into this Opportunity Zone, something like that. So if I've got a closing, well, I shouldn't say closing. If I've got a sale that's going to trigger some gain, whether it's a business, stocks, whatever it is, and I want to head into this area, this arena. How do I do it? Do I need to call a facilitator? What happens?
Well, and unfortunately for you, no, people don't need to use a facilitator for this. And the reason that people get very confused about how to do it is because it's so simple. We talked about the vehicle for the investment is the Qualified Opportunity Fund, whether it be a tiny one with you and me or the big one that Vanessa has got going. All people have to do is put their gains in the checking account for the Qualified Opportunity Fund within 180 days. Now that everything related to this has its own set of bells and whistles, and this does as well. For example, there is no tracing of dollars like there would be in a 1031 exchange.
So actual constructive receipt is irrelevant.
Right. And so you get your gains. Also, the 180 days starts depending on how you held your original asset. If I sell a capital asset that's held in my name personally, then my 180 days starts the day I sell the asset. If you and I hold an asset, real property or stock or whatever, in a limited liability company, that's a flow-through entity. So we don't recognize our gain until the end of the year of the sale. So if we're each going to get $1 million in gain from the sale of a real property that's held in an LLC, and we sell it on June 30th, then we don't actually recognize our gain until December 31 of that year. And so you have until June 30th of the following year to put the money into a Qualified Opportunity Fund.
So what if you had it personally and then you put it into the LLC pre-disposition?
I don't know.
That's a good strategy.
Yes,
possibly.
There you go, possibly. But
give Coni a call.
Give me a call.
She'll have the answer,
and I'll check that out. So there are some anti-abuse provisions in that were just passed. So I mean that's going to be similar to the drop and swap. Right? You're talking about a reverse drop and swap.
Yeah, exactly. So that's one of our biggest headaches.
So that's the timing that you have to do it. And the reason that people think that there's something more is because the process is pretty simple. It's pretty simple to follow. And so since there's no tracing of dollars, let's say you have this $1 million gain and you don't want to just let it sit for 6 months or a year if it came out of an LLC, you can lend that money to someone else. You can put it with your registered investment advisor and earn some money on it. And if you're doing well and you don't want to sell those stocks, you just have to replace the money. You have to put another $1 million in to the Qualified Opportunity Fund within the time frame.
Wow.
So that's really beneficial. And they've also in the second proposed regs that came out last month, you can also contribute property instead of cash.
Wow, interesting.
So that really added a lot of flexibility.
So what happens if the fund doesn't exist and I say, Coni, I want to put this together? What does that mean? What's the timeline for that? I mean, how long does it take you to put it together?
If it is a simple limited liability company with you and me as the members, then I can get one of those done for you in a week or less, and it's a very modest amount of money to put that together. It's a simple limited liability company agreement with Opportunity Zone bells and whistles.
Got it.
Now you don't want to do this with lawyers or CPAs that are not really familiar and trained with the Opportunity Zone provisions, because there are specifics that you need to do. There's research regarding the qualification of your assets and how it was held. There's all sorts of things that impact it, but the actual formation is pretty easy. So I and the CPAs I work with, we've already studied up on
Yes.
this, right? What we're selling in our services is the knowledge that we've gained. It's kind of like the arborist. You pay him $50 for cutting off the limb. You pay him $500 for knowing where to cut.
Yeah.
It's the same thing with the education in this kind of a new program with the CPAs and the accommodators and the lawyers that are working in this area.
Definitely.
Now, one thing that you can't do, unfortunately, is you can't start a 1031 exchange, park your money there thinking that you're going to be able to invest it if it's an individual investment, because accommodators are not supposed to release their money until 181 days if the exchange doesn't go through.
So what's critical, they're going to have to make a decision. We have to deal, unfortunately, with a 1031 G6, which means you can't get your money until you have acquired everything you have the right to buy. So at no time prior to the 45th day, you can get it, period. No way. But after the 45th day, if nothing's been ID'd, they should be able to get money to you.
Okay, but if
yeah.
you have identified
but if
something...
you've identified something, you can't kill your 1031 and get your money to Coni for the fund. So that's something I think is a very important point. So if this is something, we always tell you that 45 days is critical. You've got to be committed either to complete the exchange or torpedo it at that 45th day. If you want to go into an OZ, the opportunity zone, you've got to turn that, if you've turned an ID in, go back and take it out. Just say, hey, I'm rescinding the ID. I want my money. I'm not going to buy any of those things. Very, very important clarification. One last thing I want to mention on the LLCs. Pay somebody that knows. I mean, you wouldn't believe with IRA Advantage how often somebody comes and says, well, I can put an LLC together, or I'm going to use LegalZoom and all. It does not work. And you've got to know that the people you're working with, paying to do this stuff, they have to know what they're doing, because if we're talking IRAs, the trust companies are not going to take stuff that's not right. In this world, the IRS is not going to accept something that doesn't fit that rationale. So pay somebody that knows, somebody that's got the background to do it, and you're going to be much better off in that situation.
And with respect to that, there is very little compliance that is drafted into the legislation or into the regs so far, and we understand that this is going to be regulation light. In other words, they're not going to overregulate it, which means that this is not going to be some of the less clear elements are not going to be decided until the IRS audits someone after the fact, and that audit is appealed. And so it's going to be sorted out in tax case law eventually, but that's a long time, and you're going to be very far into this deal before that all comes about to find out that you didn't set it up right on the front end.
So once again, you better have somebody involved that's got some rationale as to why things were done the way they were,
right,
and is there to help you if this is ever something that's challenged.
Exactly.
So thank you once again, David Moore with Equity Advantage, Coni Rathbone, Dunn, Carney. Thank
Thanks.
you.